has turned in a performance never seen by anything else remotely, effectively just a money printing machine. No one knows how it works. I've met with Jim Simons one-on-one for 3 hours, and 3 hours later, he's been chain smoking, he smokes like a chimney, never wears socks, very eccentric guy, brilliant as the day is long. He says, well, Eric, that's brilliant. If you knew what we were actually doing, you'd be very disappointed. He said, I never thought of it.
As a star student at MIT, James Simons was on track to be one of the university's youngest professors. Simons, who goes by Jim, studied mathematics and would soon publish groundbreaking research in the field, use his skills to crack Russian codes during the Cold War, and become a multi-billionaire through business. Jim was a socialite in college and had a strong appetite for risk. After graduating from MIT at the age of 20, Jim and his friends celebrated by taking a road trip from Massachusetts to Columbia. They decided to use small Vespas for this trip and almost died several times during their journey. After accidentally inciting a mob of machete-wielding men shortly after reaching Mexico, Jim and his friends were thrown in jail, but his charm quickly got them out, and the group eventually reached Columbia, where one of the students had a house. Jim would later come back to Columbia to start a business with the same group of friends, helping fund an equally risky pursuit he had after college.
Daniel bets ridiculously big, 400K. Wow. And Luca folds. That was not the bet he was trying to induce. Daniel's reputation earns him a win there. Bluffs like that from him are few and far between.
Poker was an outlet for Jim to leverage his strengths as a mathematician and a social charmer, while giving in to his desire for risk. And he was an avid player throughout his life. While working on his doctoral thesis at Berkeley, he discovered a new type of gambling. The well-intended Jim Simons took a couple $1,000s he had saved to a broker, who persuaded him to invest in soybean futures, assuring him that their price was going to skyrocket in the coming weeks. The prices did exactly that almost immediately, doubling Jim's initial investment. In a fitting fashion to new investors, however, he lost all his gains a few weeks later, but he was hooked to this exciting new world of trading. Jim was offered a prestigious teaching position at MIT after completing his PhD at just 23 years old. Although he accepted the job and later took another position at Harvard, he grew tired of academia and wanted more from life. He returned to his college friends, proposing to start a factory in Columbia that would produce vinyl floor tile and PVC piping. This business was in high demand in the country at the time, but required Jim to go deeply into debt, forcing him to take on additional teaching jobs from nearby colleges. His budding math career, discovery of trading, and entrance into business would lay the foundation for the decades to come. As of today, Jim Simons has generated over $30 billion in personal wealth, and has helped generate hundreds of billions for his network of colleagues and clients. Besides being an esteemed mathematician, his name resonates in the business world, trumping even the most well-known, although he remains in relative secrecy. In the 1960s, the Institute of Defense Analyses was a top-secret agency designed to crack Russian codes during the Cold War. Jim was offered a position here in 1964 that paid nearly double what he made as a teacher, and he was still able to work on his mathematics research. It was at the IDA where Jim learned how to recognize and interpret patterns in seemingly meaningless data, a skill that would soon make him billions of dollars. The IDA allowed him to use his math skills, and it paid much more than teaching, but it was still not enough for Jim. He was eventually fired from this position for his comments on the war, but he had already gotten the knowledge and the people he needed for his future plans. It was also here where he met Lenny Baum, a Harvard grad who also held a PhD in mathematics. Lenny was one of the best code crackers at the IDA and was known for his contributions to developing algorithms that analyze systems known as Markov chains. The outcome of this rally is not dependent on the previous one. The winner will score points regardless of the current score, or what happened earlier in the match. If you were at a tennis match, but the court was covered and all you could see was the scoreboard, the match would be a hidden Markov process. You would be able to see the score change, but the events within the match would not be directly observable. An avid fan who has watched thousands of matches, however, could make extremely accurate predictions just by analyzing patterns in the scores. Rapid points may indicate an ace. Quickly conceded points may indicate a fault. Lenny's algorithm provided a way to estimate probabilities in complex sequences with very little information beyond the output, and enabled things like the first speech recognition system, Google's search engine, and machine learning. Jim, an avid poker player, already knew of Markov systems. If you can only observe betting actions but not the actual cards, you can still infer what types of hands players might be holding. The hidden states in this Markov process are the player's hands. The only observations the player has are the betting actions of the opponents. If a player is aggressively raising, one may infer that they have a strong hand like a full house or a flush. If a player makes a large bet but there is no evidence of a strong hand, one may infer that they are bluffing. Poker is the ultimate game to make informed decisions off hidden states.
Okay. I'm thinking aces or kings.
You think right. Daniel really pulled the trigger correctly on that one.
Jim and Lenny wanted to apply this idea outside of code cracking and into the stock market, realizing its potential to make them a lot of money. Together, they started a new era of trading. Going against the norm, they ignored all traditional metrics of predicting stock prices, like looking at company earnings and corporate news. Just like how poker players adjust their strategies to the moods of other players, Jim and Lenny were looking for a way to predict the market's behavior based on its underlying states. Why these states impacted pricing behavior didn't matter, they were just looking for the relationship. This was revolutionary for the late 1960s, but to Jim, it was still a theory that had yet to be applied to trading.
Well, they're invariant polynomials. They're invariant polynomials under the inner automorphism. N copies of the curvature tensor. Negative. Orientation, reversing, and that there's a nice formula, but for even-dimensional manifolds, it does not. Integral over the fiber itself. Can you see down here? You are familiar. I've already gone 10 minutes over. I was going to write down what I just said, but there it is. So this
At the age of 37, after publishing several groundbreaking papers, there was nothing left for Jim to do in mathematics. He sold a stake in the Colombian floor tile company, which was starting to see success, and invested some of the money with the trader he had met at Harvard. His few $100,000 investment quickly grew to $6 million, now leading the entire mathematics department at Stony Brook University in New York. Jim became obsessed with trading and controversially left academia to start an investment firm. Jim wanted to find structure in financial markets so that he could predict price movement and profit off of it. He approached this challenge from the perspective of a mathematician, searching for structure in chaos. How does structure emerge from chaos? Jim asked this question in the context of financial markets. Just like how there are patterns in the seemingly chaotic nature of weather, Jim suspected there were patterns in financial markets that others weren't seeing. Jim realized he could use his code-breaking skills to spot signals in the financial markets and bet on price movements. Bringing Lenny Baum with him, he founded a hedge fund called Monometrics and attempted to apply pattern recognition to financial markets, something nobody else had considered at the time. The duo started with currencies, building a basic model that automatically gave them instructions to buy currencies if they veered too far from their average price. Jim managed to secure a few $1,000,000 from his Colombian friends to trade with, serving as the initial investment for the firm's fund, which he named Limroy. Lenny was tasked with developing the models, while Jim hired other genius mathematicians and found wealthy clients to contribute to the fund. His next recruit was James Axe, a PhD mathematician whom Jim knew from Berkeley. Axe discovered that Jim and Lenny's models could be expanded to trade commodities, and he began contributing to the development of them. The trio of genius mathematicians had a streak of successfully predicting the moves of major currencies and commodities, and the fund grew from a few million to around $20 million in its first year.
We were extremely successful. I think it was just plain good luck, but nonetheless, we were very successful. And in looking at the patterns of prices, I could see that there was something we could study here, that there were maybe some ways to predict prices mathematically or statistically. And I started working on that and then brought in some other people. And gradually we built models, and the models got better and better, and finally the models replaced the fundamental stuff.
Perhaps it was luck, because Jim hit a downturn quickly after as the firm began to lose millions, and Jim was forced to provide explanations to angry investors as to why they were losing all of their money. He knew he had to find an even stronger mathematical approach and develop the models to a point where there was no human intervention and no error. But the only way to get this to work was with massive amounts of data. Like the tennis fanatic who has watched thousands of matches, or the poker expert who has seen millions of hands, Jim needed as much market information as he could get. He bought hundreds of books from the World Bank, each filled with prices for commodities, bonds, and currencies dating back to the early 1900s. Every morning, his staffers filtered through the Wall Street Journal and manually recorded the closing prices of major currencies. This data was input into a monometrics database where prices were tracked and trading strategies were tested. The system would generate a recommended currency portfolio, and a staffer would deliver buy and sell instructions to a broker, holding positions for a day or two before selling. These were the origins of high-speed trading based on data, and it seemed to be working extremely well for Jim. The firm grew to 30 million, and the offices expanded into the neighboring space, and Jim would frequently take employees on his new yacht. The firm was also renamed from Monometrics to Renaissance Technologies Corporation. Lenny himself made over $40 million in profits between 1979 and 1982, but after a few costly trades that went sideways, Lenny's investments were suddenly cut in half, activating an automatic clause in his agreement with Jim, forcing Lenny to sell his ownership in the company and leave. The Star Fund was losing millions of dollars a day, and Jim again had to field constant calls from angry investors. Now just Jim and Axe remaining, they had to figure out how to stop the bleeding and turn the fund around. They knew they had to move to other financial instruments to keep growing, so they hired Sanders Strauss to help them expand to bonds and help refine their currency and commodity trading. Strauss went on to collect even more data than they already had, even to the point of hourly fluctuations of various instruments. He and Axe were starting to get somewhere by looking at all of their data on pricing history. Jim continued to recruit renowned mathematicians to help, as well as physicists and computer scientists, but no finance experts. Jim was unique in that he intentionally did not hire anyone from a finance background, as he did not want any preconceived notions from Wall Street that could influence the models. He simply wanted extremely intelligent individuals, and many of these individuals did not even know anything about the companies they were trading. By 1986, the small team was trading over 20 different financial instruments, with decisions generated mostly by mathematical formulas, but still, there was nothing groundbreaking, and competitors were starting to use similar trading methods. Renaissance was attempting to achieve something every other trader has tried to throughout history: predict the future. Some relied on charting patterns to predict prices, others relied on the alignment of the stars. Either way, they were all essentially just guessing. Jim was adamant that his team could predict the future with math just well enough to profit consistently. They just had to figure out how to apply their theory. Renaissance's initial trading method assumed that asset prices were directly related to a few variables. Things like historical stock prices and company earnings were assumed to have a direct impact on prices. Renaissance knew this wasn't entirely accurate because asset prices are impacted by thousands of factors, some of which may be seemingly irrelevant, and often have disproportionate impact on prices. Returning to the tennis hidden Markov process, what if the score suddenly stopped moving? Perhaps it could signal the match ended, or there is a weather delay. If we make the court visible again, something completely unexpected is revealed that would certainly have an impact on the state of the game. Financial markets have thousands of underlying variables that are unexpected but all interconnect to impact prices. Renaissance raced to become the first to build a system that could predict price movements off of these hidden variables that nobody else was looking at. It came up with a relatively simple solution: have computers search for relationships in the data Strauss had painstakingly gathered to find instances in the past of similar trading environments and see how prices reacted. Jim and his team developed a model that found complex patterns in price movements based on historical data, or regressions, and a wide variety of other factors, known as dimensions. It then suggested trades. However, nobody understood how it worked, as it was analyzing so many different variables at once. Despite its mysterious nature, this method worked well, and Renaissance's main fund Limroy grew 20% in the same year. The model was soon refined to focus on two core strategies: It either chased prices, buying commodities that were moving higher or lower and were expected to trend, or it would bet that a price move was slowing down and would soon reverse, a reversion strategy. This worked well for short-term trades, but a few months later, the fund started to fall apart. Losses on its long-term trades caused the fund to tank, and the firm started to weaken as well. Lenny Baum left, and James Zak sold his shares to another colleague and quit, and even Simons was losing interest and started to grow distant. But everyone else was joining the party. The explosion of the finance industry in the 80s brought incredible wealth to Wall Street firms, and individuals were making billions by trading simple financial instruments. This bothered Renaissance, a computer scientist named Elwyn Berlekamp in particular, who was the partner who had purchased Axe's shares. He thought these new Wall Street traders were just getting lucky, as they were fundamental traders, making decisions on a few widely known signals. Berlekamp, who took control of the model, began by implementing recommendations that had been shelved by previous employees. His focus was solely on short-term, rapid trading, suspecting it would actually be more profitable than long-term trading. Renaissance's advantage was that it had the most sophisticated analysis. It just didn't work well for long-term trades. One bad trade would frequently erase several successful ones. Berlekamp realized, however, if Renaissance had thousands of small trades providing small returns, the consequences would be very little if one went wrong. The casino only needs to win a little over half of its total wagers. It will always come out ahead due to the sheer volume of wagers it makes each day. Berlekamp's logic was to treat trading like a casino, make a ton of trades at a slight statistical edge. The law of large numbers would be on their side, just like it is for casinos. But he still had to discover how to get an edge in the first place. He and the team closely examined tens of thousands of market events per day. The trends they discovered were so obscure and occurred so quickly that a normal human would never see them. In many cases, they didn't even know why they occurred, but the trades worked. An example of one of these trends was Deutsche Marks. Renaissance discovered that when this currency rose, it had a strong likelihood of rising the next day and the day after. The same was true when the currency fell in value. There was no apparent reason for the currency to rise again just because it did the day before, but it did anyway. It was immediately clear these short-term trading signals worked because Renaissance was making over $1 million per day, the most it had ever made. The transformed fund, now named Medallion, would go on to be the most successful fund of all time. Renaissance was truly years ahead of its time. Jim and his team knew this was a better way to trade, but it wasn't until the late 80s and early 90s that computing power was at the point where it could make use of all the data Renaissance had collected from the decade prior. Its competitors either didn't exist or didn't think to do this so early on, giving Renaissance several years of advantage over them. The new approach was to trade on these short-term signals, holding positions for less than a day, instead of 1 to 2 weeks they were doing prior, and make thousands of trades per day. The problem was that Renaissance was only managing around $30 million, a relatively small amount compared to the Wall Street firms managing billions. Renaissance was struggling to compete with these larger firms, which were starting to catch on to Renaissance's secrets, and had much larger bankrolls to work with. D.E. Shaw was one of these competitors, also housing an army of extremely smart people, including one of its early hires, Jeff Bezos. This fund managed 10 times what Renaissance had, and also enjoyed annual gains double that of Renaissance's. Over the next few years, Jim pushed the team to their limit, but the firm was making marginal improvements. Renaissance dominated currencies, commodities, and bonds, but there was only one way to grow further: expand into stocks. The stock market was where the real money was at for these types of traders. Stocks had much more activity than currencies and commodities, meaning more potential for profiting off of price discrepancies. But with this came with more noise, making it much more difficult to unearth trends and find accurate signals. Jim found solace in speech recognition. Peter Brown and Bob Mercer laid the groundwork for speech recognition advancements at IBM. These enabled things like Amazon's Alexa, Apple's Siri, and Google Translate. The underlying technology of these advancements involve using algorithms for pattern recognition in speech and predicting the most likely outcome of words. This technology was extremely useful to Jim because he was trying to apply the same thing to financial markets. Jim doubled their salaries and brought them aboard Renaissance. At this point, Renaissance was facing significant struggles with stock trading, and these two new hires were tasked with discovering breakthroughs. They tweaked the model so that it could learn and adjust trades on its own, self-correcting itself when recommended trades weren't executed for whatever reason. This was the first time something like this had been created, a completely automatic trading system that could self-adjust based on its own decisions. The core strategy of the model was still relatively simple, betting that stocks would eventually revert back to their average prices. The model was working, but it still wasn't perfect, and Jim wanted more. In 1995, he recruited David Magerman, also from IBM.
They hadn't figured out how to trade in the stock markets. And part of the problem was that their software systems couldn't deal with trading thousands of stocks at the same time. They could trade, individual instruments like individual bonds. They could trade dozens of futures contracts and bonds. They could trade 5 or 6 currencies at a time, but they didn't know how to scale their systems up to trade thousands of stocks together.
Magerman realized that although the fund looked good on paper, it didn't consider rare events the model would sometimes experience that would lead to huge problems. The fundamental strategy of the model was to place frequent wagers of small amounts on reversion to the mean predictive signals.
At the end of the day, our system worked because we had an edge over everybody else because our models predicted the markets, predicted what was going to happen well enough for us to make money like a casino.
While it executed this strategy well, there were instances when it did things like attempt to short stocks that weren't available, allocate too much money to a particular stock, or at times, even buy out an entire company. Renaissance had to figure out how to solve hundreds of problems simultaneously, as each one impacted the trading decision. Jim was becoming impatient and tasked Brown, Mercer, and Magerman with revamping the model yet again. The team worked together to program a single trading system capable of automatically handling all potential complications. All trading signals and portfolio requirements were integrated into this model, and it would output optimal decisions all day long. The system was adaptive, meaning it could learn and adjust on its own, just like today's machine learning applications. If a trade wasn't executed, it self-corrected by searching for buy or sell orders to adjust the portfolio back to where it needed to be. The system looped several times an hour, each iteration evaluating thousands of potential trades before issuing electronic trade instructions. With this, Renaissance became the first of its kind. No rival had self-improving models. Renaissance's Medallion fund quickly became the most successful fund of all time, and it continued to improve as Renaissance collected more data. Renaissance was as much of a data collection company as it was a hedge fund, collecting everything from trade orders, government reports, economic papers, and even obscure things like offshore insurance claims. Its biggest rival, Long-Term Capital Management, which once managed $7 billion, was wiped out within weeks in 1998 after one instance of market panic. Renaissance's other competitor, D.E. Shaw, had a leveraged portfolio of around $20 billion, only to lose $200 million in 1998 as well. However, Medallion, Renaissance's fund, grew 42% in 1998, the same year its competitors were losing hundreds of millions, and in some cases, billions in less than a month. By 2000, Renaissance managed around $5 billion, and its growth seemed to be unstoppable. Until March 2001, when its Medallion fund lost $90 million in one day. The next day, it lost an additional $80 million. The day after, another $90 million. The office was sent into a frenzy, looking at Jim to make a call. Their models had never lost more than a few million in a single day, and they were accustomed to gains well over 50% each year. Suddenly, the firm was less than a week away from collapsing. There was no time to revamp the model, but after several all-nighters, researchers discovered the problem. The model was purchasing shares because they were consistently trending downward, a simple trading signal used in times of declining markets. The model did not, however, account for catastrophic market events like the dot-com bubble bursting, and was operating as if it was a normal event.
We were losing over $1 billion a day. I mean, think about that. And It was all because of this phenomenon that hedge funds push prices of instruments around in ways which don't reflect their fundamentals. And if a big fund decides to dump all its stock, then it's going to have the market's going to have a problem.
Jim, plagued by similar events that occurred in the early days of Renaissance, went against everything he built and commanded to override the model, putting an end to the trading signal and the losses. Less than a year later, Medallion doubled in size, but this event and other scares in the past scarred Renaissance. It was also struggling to grow beyond the $5 billion it managed without significant risk. The solution was an extremely clever instrument called a basket option. By this point, Renaissance had built a strong reputation and banks were eager to work with it. Banks like Deutsche Bank and Barclays began selling these basket options to Renaissance, with the trading values tied to the performance of specific baskets of stocks. Renaissance's models told the banks which stocks to place in their baskets and at what price to trade them at. This made the banks who sold these basket options to Renaissance the legal owners of the shares, although Medallion owned the basket options containing the underlying shares. This was important for two reasons. It allowed Renaissance to trade with significantly more money than it would have been able to otherwise. The $5 billion it managed effectively turned into $60 billion, while only risking a few $100 million in collateral, as it wouldn't have to buy the underlying shares. It also allowed for its short-term trades to become eligible for long-term capital gains tax because the options were exercised after 1 year, even though the trades only took a few days at most. Now it was only paying 20% in tax instead of the 40% it would have paid otherwise, saving nearly $7 billion in the 10 years the firm used this method.
Okay, well, good morning,
There's
Chairman.
a button on the base of the mic. Be sure to press it in and pull the mic closer.
No, I think it's on.
Okay, good.
Is it on? Yeah.
Good.
Oh, good morning again.
How many times?
I don't know how many times.
Oh, how many times in a year?
A few. Well, I don't know if it's 30 million or 35 million or 40 million. It's millions, many millions.
Tens of millions.
Yes. No,
Barclay-
that's not what happened.
Well, could you?
Could we have
Did you shift any money from Barclays to Deutsche Bank?
shift money? No.
Okay.
Yes, as I said, the changes are modest, but yes.
Who changes their minds? Human beings?
Who changes their mind?
What did you just say? Change
These
their
are
mind?
modest.
Your models.
Small.
You make changes in the models.
Yes, they're modest changes in the models.
Modest changes in the models by these human beings.
That's correct.
Renaissance's problems were now centered around making too much money, leading to investigations and even worries of employees stealing secrets.
The law of large numbers tells a mathematician that if you run your operation like a casino, casinos are always going to make money. And Renaissance was a casino.
It was too late for competitors. Renaissance had survived where others failed and was now unstoppable. Jim and his team pioneered and mastered the new field of quantitative trading. Although there are now other players operating in a similar capacity to Renaissance, none have been doing it for as long or as consistently. Jim Simons eventually retired and gave control of the firm to Brown and Mercer in 2010. The Medallion Fund managing $10 billion at the time, and two separate funds managing an additional $6 billion. In 2019, Medallion had average gains of 66% since 1988, and at times made up 5% of daily stock trading volume. Renaissance was the first hedge fund to successfully trade off the fact that there is more that influences investments, including forces that are not easily visible. Everything in the stock market is connected, and by analyzing thousands of variables, hidden patterns can be found in the noise. Renaissance even found mathematical relationships that had to exist according to Jim, because all companies are interconnected in complex ways. Just like how a chaotic storm is the accumulation of millions of tiny interconnected weather events, Renaissance built a machine learning model to predict this interconnectedness and its changes over time, and made billions off of it. It figured out how to put all these forces together in an automated system, even with every bet being a function of all other bets. Jim Simons, who already found great success in mathematics, did the same in business. He has since publicly given over $5 billion to philanthropic causes.
The short talk is this.
I did a lot of math. I made a lot of money, and I gave almost all of it away.